The Iron Condor is a popular options trading strategy designed to generate income by capitalizing on low volatility in the underlying asset. It involves selling both a call spread and a put spread, creating a range within which the asset's price is expected to remain by expiration. This strategy is market neutral and benefits from time decay, making it ideal for traders looking for steady, consistent returns. 0 DTE stands for 0 days to expiration, referring to options that expire on the same trading day. These options have gained popularity among traders due to their potential for rapid profits within a short time frame. 0 DTE strategies, including the Iron Condor, allow traders to take advantage of the final moments of time decay and volatility contraction, offering significant return potential if managed effectively. Since 0 DTE trades occur within a single day, effective risk management is critical. Traders must carefully select strike prices, monitor market movements, and set predefined exit strategies to avoid excessive losses. While 0 DTE Iron Condors can generate quick income, they also carry inherent risks, such as sudden price swings and limited reaction time. Proper position sizing, stop-loss orders, and volatility assessments help mitigate these risks. An Iron Condor consists of 4 option legs. Sell a lower strike put, buy an even lower strike put to limit risk, sell a higher strike call, buy an even higher strike call to limit risk. The strategy benefits from low volatility, as a stable or range-bound market allows the sold options to decay in value, enabling traders to buy them back cheaper or let them expire worthless. It is a credit spread strategy, meaning the trader collects a net premium up front, which represents the maximum potential profit. The maximum risk is defined as the difference between the strike prices of the call or put spreads minus the net premium received. Assume stock XYZ is trading at $100. A trader might establish an Iron Condor as follows: sell a 98 put and buy a 96 put, sell a 102 call and buy a 104 call. If XYZ stays between 98 and 102 at expiration, the trader keeps the entire premium received. 0 days to expiration options, or 0 DTE options, are contracts that expire on the very same day they are traded. Because of their rapid time decay and sensitivity to price movements, they offer high reward potential, but also come with increased risk. Rapid premium decay occurs when the sold options lose value quickly, which benefits short premium strategies like the Iron Condor. Quick profit potential is one of the key attractions of 0 DTE options. Traders can capitalize on intraday price stability, making it an appealing strategy for those looking to make profits within a single trading day. Many underlying assets have options expiring multiple times a week, allowing traders to deploy strategies frequently. Unexpected price moves can lead to significant losses. Unlike longer-term Iron Condors, 0 days to expiration trades require fast decision-making and execution. Liquidity issues. Rapid price fluctuations may impact bid-ask spreads, making it difficult to exit trades efficiently. 0 DTE Iron Condors, higher reward potential in a short period but require active monitoring and rapid execution. Longer-term Iron Condors, more time for adjustments and lower sensitivity to sudden price moves but accumulate profits slower. Strike prices should be selected based on implied volatility and expected market movement. The ideal setup occurs in a low volatility environment with defined support and resistance levels. Traders should monitor economic events and news that could impact market conditions drastically. implementing stop-loss levels to manage risk if the price moves beyond the expected range. Rolling or adjusting spreads when price action challenges a strike level. Exiting trades early if the majority of the premium has already been captured before expiration. The strategy offers defined risk with a limited reward structure. Balancing strike width and premium received is crucial to optimizing profitability. Managing early exits can prevent full loss scenarios when markets become unexpectedly volatile. High probability of success. If well structured, most trades result in capturing premium decay. Quick results. No overnight risk and profits can be realized within hours. Flexibility allows traders to adjust and manage risk dynamically throughout the trading day. Time decay sensitivity. While beneficial, rapid decay also means losses can mount quickly if the trade moves against expectations. Market unpredictability. Sudden market shifts can break through the expected range, leading to losses. Transaction costs. Frequent trading incurs commissions and fees that can eat into profits over time. The 0 days to expiration Iron Condor is a powerful strategy for traders seeking short-term income opportunities. While it offers quick results and flexible trade management, it requires precise execution, disciplined risk management, and an understanding of market behavior to be successful. Identify the current market trend and volatility levels. Determine support and resistance levels to define a reasonable trading range. Select strike prices outside these levels to increase the probability of success. Sell a put option at a strike price below the current price. Buy a lower strike put option to limit downside risk. Sell a call option at a strike price above the current price. Buy a higher strike call option to limit upside risk. Ensure the credit received provides an adequate risk-reward balance. Continuously monitor price movements and volatility. Exit or adjust trades if price moves too close to the short strikes. Consider rolling spreads or closing positions early to secure profits or cut losses. Assume stock ABC is trading at $200. A trader might set up a 0 DTE Iron Condor as follows. Sell a 195 put and buy a 193 put. Sell a 205 call and buy a 207 call. The total credit received is $1 per contract. If ABC remains between 195 and 205 at expiration, the trader keeps the full $1 profit per contract. If ABC moves beyond the short strikes, adjustments or early exits may be necessary to manage risk. Stop-loss orders. Predefined exit points help limit downside risk if the market moves against the trade. Delta adjustments. Hedging techniques such as adding offsetting positions can reduce directional exposure. Closing positions early. Exiting a trade before expiration can preserve capital if risk levels increase. Sticking to a predefined strategy helps prevent impulsive decisions. Position sizing ensures that no single trade significantly impacts the account balance. Accepting small controlled losses is crucial to long-term profitability. Wider bid-ask spreads in fast-moving markets can make entries and exits challenging. Poor liquidity may lead to slippage, affecting profitability. Using limit orders instead of market orders helps control trade execution prices. Markets can be unpredictable and sudden price swings can breach the expected range. Always account for potential volatility even in seemingly stable conditions. Frequent trading incurs costs that can reduce net profits. Consider commission structures and slippage when calculating potential returns. Over-leveraging can lead to significant losses if the trade moves against you. Ensure adequate capital is allocated to avoid forced liquidations due to margin calls. Success case. A trader correctly identifies a low volatility day, selects appropriate strike prices, and captures full premium as the market remains within range. Failure case. A sudden news event causes unexpected volatility, breaching the short strikes and resulting in a significant loss. Always monitor market catalysts. Be prepared to adjust or exit trades quickly. Maintain disciplined position sizing to limit exposure. Bloomberg, CNBC, and Reuters provide real-time financial news and market-moving events. Platforms like Forex Factory and Investing.com help traders track important economic announcements that could impact volatility. Monitoring the VIX, or Volatility Index, and IV rank, which stands for Implied Volatility Rank, helps assess market conditions before entering trades. Before diving into live trading, it is highly recommended that traders practice with paper trading accounts or smaller positions to develop confidence and refine their approach. By combining experience, strategy, and risk management, traders can effectively navigate the challenges of zero DTE Iron Condors and enhance their chances of success in the fast-moving options market.